Let us start Unit 10 on risk management. Risk management is a very important topic. It's a contemporary topic and it's very important for bank interviews. At least the basics are important. Many banks are placing a lot of importance on this aspect because of what are known as Basel norms, which we'll discuss shortly. At the same time, this topic is quite advanced, so there might be many concepts that will be difficult for you to grasp. So just try to get an overview of the topic. You need not get into much depth. Just the bare basics of risk management will be sufficient for your interviews. So banks face a lot of risks. So one common interview question is, what are the various types of risks bank face? So let us see them. Credit risk, market risk, operational risk, liquidity risk, business risk, reputational risk, systemic risk, moral hazard, legal risk, and country risk. So there's a variety of risks banks face. Of these above, the most important that you need to focus are credit risk, market risk, and operational risk. All banks have dedicated risk management departments which monitor and manage risks. Let us see each of these risks in brief. Credit risk is the risk that a borrower will fail to meet the payment obligations. So we've seen that banks lend loans to companies. There's always a risk that some borrowers will not repay the default of the loans. Not everyone. Most of them pay, but some borrowers will not pay. Well, they fail to repay the loan. So that risk is always there. Those ultimately turn into NPAs. Okay. So that is the risk. Okay. Risk is the borrowers will fail to meet repayment obligations. Then there is something called market risk. Market risk is the risk that arises. Banks face losses due to movement in market prices. There are various techniques to measure market risk, such as VAR, that is value at risk, sensitivity analysis. All these are advanced techniques which you need not know. But briefly, value at risk is like the maximum loss not exceeded with a given probability over a given period of time. You can leave it for right now. There are some components of market risk like interest rate risk, equity risk, foreign exchange risk, and commodity risk. Let us see them briefly. Interest rate risk is a potential loss due to movement in interest rates. So we already discussed briefly about asset liability management. So banks have this a dual balancing act to do, right? On one hand they accept deposits and other hand they lend loans. And usually banks loans have higher longer maturity than its liabilities, that is deposits. For example, loans mostly term loans for companies will be around 5 years to 7 years. Home loans are much longer, 10 years. Whereas if you see deposits, mostly they are 1 year deposits, 3 year deposits, 5 year deposits, like that. Okay. So usually bank will be having longer maturity on the assets than on the liabilities. So that interest rate risk has to be managed in that area. So that is the interest rate risk. Then there is equity risk. It is the potential loss due to an adverse change in the stock price. So banks, we discussed earlier that one type of security banks can accept is the shares, collateral security, shares of the company. So if the share price of the company falls, so that is the risk bank is facing. Also, as part of its investment strategy, if banks have surplus funds, they sometimes invest in other company shares. And if the stock price of that shares decrease, so that will lead to the investment value of the banks will fall. So that is an equity risk. Then there is foreign exchange risk. Banks deal with a lot of foreign exchange. So we'll discuss about how foreign exchange rate is determined, like how $1 is so and so rupees, how is it fixed and all. So if there is change in that exchange rate, banks will have to bear loss. So that is a foreign exchange risk. Then there is a commodity risk. Commodity risk is the potential loss due to adverse change in commodity prices. Now these commodities can be agriculture commodities or even metal commodities, energy commodities. This usually happens in the derivative segment, which we'll discuss about briefly later. Then there is operational risk. This is the risk of loss resulting from inadequate or failed internal process. people and systems, or from external events. Say for example, this is like the risk due to day-to-day operations. Banks, because they do deal in cash and a variety of processes, paperwork, there's always a risk of failed process. For example, a cashier clears a check which is forged, so that is an operational risk. Okay, so this definition also includes legal risk but excludes strategic and reputation risk. So most of the operation risk, if you see, it arises from one of the three sources, either from people or information technology or process. So people risk is like the bank staff misusing their powers or applying wrong processes, okay, incompetence, or maybe wrong people are posted to the some crucial department. So that will be people risk. Information technology risk is like the failure of the information technology systems, like the system could be hacked, or the server could not take the load and crash, and these sort of things. Like those are the risk from a information technology point of view. And there's a process related risk. So these are the possibility of errors in information processing, data transmission, and data retrieval. Then there's liquidity risk. Liquidity means a bank has the ability to meet payment obligations of its depositors and enough money to give loans. So banks accept deposits and lend money. So liquidity means banks has sufficient money in the system. So banks, if somebody a company comes for loan, bank has sufficient funds to lend loans. And similarly, banks borrow from outside parties. Banks also have some borrowings, not just depositors. Say from the money market and other avenues. So when the time comes to repay these depositors or other parties, bank should have sufficient funds to repay them. Okay, so that is liquidity. It is having enough cash. Okay, liquidity risk is a risk that a bank is not able to repay its deposits or depositors or give loans. And this is very important. Adequate liquidity in a bank is very crucial, because you might have never come across a situation where you went to a bank and bank said we don't have cash. It might have happened at ATMs but never in a branch. Okay, that's because banks always have liquidity. That's very crucial issue, because the entire confidence of the banking system depends on this. The day the bank say it doesn't have money, doesn't have sufficient money, there's a loss of reputation for the bank. So liquidity risk is very important from operations point of view. Then there's business risk. It's the risk arising from a bank's long-term business strategy. Okay, so bank maybe it's not changing as per the competitive landscape and starts losing market share. Other competitors are overtaking it. So this could be like bank taking a wrong strategy. For example, a bank which has strong share in the southern market might decide to start more branches in northern part of India. But if happens to fail to get good market share, that would be a business risk. A reputation risk. This is the risk of damage to a bank's image, public image. Like for example, this could be like frauds committed by employees. It could be negative publicity, either in the media or social media. Reputation risk leads to loss of public confidence. It could also be due to the manipulation of records at the top management level, bad customer service, harsh staff behavior. All this lead to reputational risks. Then there is systemic risk. Systemic risk is not particular to the one particular bank. It affects the entire financial system. Right? It's the possibility that default or failure by one bank can cause failure of the other banks. It threatens the stability of the entire financial system. But this type of scenario happened in 2008 across the world. Then there is moral hazard. It is a situation where bank employees take high-level risks, even if it is economically unsound. Right? Usually, it happens at the top management level, at the level of chairmen and managing directors or general managers. Okay. Then there is legal risk. Legal risk can be a form of a financial loss arising from legal suits filed against the bank. Customers can or borrowers can apply suits against the borrowers, against the banks. And if bank loses that case, that will be a legal risk. So today banks have branches in other countries also. Indian banks, though most of the branches are present in India, they also have some overseas branches. So country risk is a risk where a local problem of that particular country affects the bank. Okay, So in such a case, the bank's holding company, the parent company, needs to bear loss. So that would be a country risk. So the questions you need to be prepared in this chapter: name some types of risks banks face. What is credit risk? Give an example. What is market risk? What are the major components of market risk? What is interest rate risk, equity risk, foreign exchange risk, commodity risk, operational risk? Give an example of operation risk. What are some sources from which operation risk arises? We discuss that. What is people risk? What is information technology risk? What is process related risk? What is liquidity? Liquidity risk. Why is adequate liquidity in a bank very crucial? Because the confidence of the bank in the public will be based on the liquidity. What is business risk? Give an example. What is reputational risk? Give an example. What is systemic risk, moral hazard, legal risk, country risk? We'll discuss all this.